Hey everybody, Rob Maurer here, and today we're going to be talking about a couple of new analyst notes on Tesla from Credit Suisse and Deutsche Bank. Also got a couple of new updates on Tesla products and an update from Tesla in China, but otherwise it's been a relatively quiet news weekend for Tesla. I think everyone kind of just digesting earnings still. As you can hear, my voice has decided to once again leave me. I really apologize. Despite all that free medical advice I got in the YouTube comments, somehow this has happened again. I am getting enough vitamin D, just to point that out. I am aware of that, actually. So hopefully we can spare those comments today, but I'm feeling fine. I think we'll be better tomorrow, but you'll just have to bear with me for this one, and we'll try to keep it short today so that I can indeed recover. Thankfully, me sounding like death has not correlated with the market. Tesla today finishing up 10.7% to $936.72. The NASDAQ, great day, up 3.4%. So a lot of high growth stocks today outperforming. I think tempting to look at this and say, oh, the sell-off after earnings, people realized it was overdone and now they're buying back in. But I think most of this is just some of that rotation benefiting Tesla today, which is actually probably good news because if and when Tesla does decide to do its own individual recovery, hopefully there's a little bit more upside beyond where we're at today. The reason I say that is if you look at a basket of other electric vehicle stocks or related stocks, you can see that a lot of them up anywhere between 8 and 15% today, Tesla kind of in that middle range. And if you look at ARK's Innovation ETF, then that was up 9.5%, so pretty close to Tesla's performance, even though that's a basket of 90% not Tesla stocks. So nice to see some recovery, but I'm still not forgiving the market for being wrong on Tesla quite yet. All right, this morning we did get a pretty significant analyst update. This was from Credit Suisse. They have not changed their price target, but they have upgraded their rating on Tesla stock from neutral now to outperform. As we've talked about before, oftentimes the price targets get a little bit overrated from analysts, I think, and some of the content, the research, and the actual rating is underemphasized. And especially in the case of the rating, oftentimes that influences what financial advisors or portfolio managers at that bank will recommend or invest in. Oftentimes, if it's a sell or an underperform rating, they'll just leave those stocks out. So neutral to outperform, maybe not quite as big of an impact as something like underperform to neutral or underperform all the way to outperform, but it is still pretty meaningful and probably gets a little bit more attention than some small price target increase would. Anyway, getting into the note, this was another long one from Credit Suisse, about 30 pages. You may remember a couple weeks back we had a really good note from Credit Suisse, so we won't go into quite as much detail on this one, a lot of the same tenets as that old note, but they do say about the rating upgrade, quote, with the market disproportionately punishing growth stocks in the past month, we believe an attractive entry point has emerged for Tesla, and we upgrade to outperform from neutral. Tesla is a one of one. We are hard-pressed to find a stock that checks all the boxes as Tesla does. Attractive growth story, both top line and EPS, disruption, decarbonization, etc. Accordingly, with robust fundamentals ahead and the stock having been caught in the market decline, we believe the stock should recover. We upgrade to outperform rating and maintain our $1,025 target price. End quote. So great timing with this call as Credit Suisse seem to be saying that growth, especially Tesla, has been overly punished, and a reversal of that is definitely what we have been seeing today. But they do highlight this as a key risk to their call as well. They say, quote, a key risk to our call is that growth remains out of favor. Tesla's year-to-date underperformance, down 20% versus S&P down 7%, can be explained by a market that has punished growth. Year-to-date value stocks have relatively outperformed by 12%, while growth stocks, i.e. Tesla, have underperformed by 7%. As any positive outlook on Tesla must use a long-term valuation, a risk to our call is that rising rates pressures secular growers, end quote. So this is a lot of what we've been talking about, right? Right now, Tesla's price is a little bit arbitrary as the price to earnings multiple compresses, but as Tesla continues to report these great quarterly results, there's only so far down that multiple can go, even in a tougher environment for growth. And we've seen too that rising interest rates doesn't necessarily mean that growth stocks can't succeed during those periods of time, as we talked about with Amazon, and that share price appreciation that it saw, even with the high multiple from that 2017 to 2019 period of time that we looked at, that had rising interest rates. Anyway, on that multiple compression, you can see that playing out through Credit Suisse's forecasts. They show their numbers for 2022 and 2023, their estimates. And then at the bottom, they show the price to earnings ratio that the stock would be when they published this note, which was about $845. And from their earnings estimates, they're seeing a multiple of 65 times in 2022 and 49 times in 2023. Now, those are non-GAAP numbers, so GAAP numbers would be a little bit higher multiple. But at the same time, Credit Suisse is only forecasting 1.5 million and 2 million vehicles delivered respectively for 2022 and 2023. I think Tesla will beat both. They did have a nice chart though that shows how their non-GAAP earnings per share numbers compare to consensus, and they are quite a bit higher, about 25% on average, which, again, based on my own expectations, should highlight how far off I think consensus really is at this point in time, especially for 2023. Wrapping up with their note then, a couple of nice charts they shared on Tesla's margins versus competition. First here, earnings before interest and taxes margin versus GM and Ford. Clearly no contest there, and Tesla's continuing to rise, GM and Ford leveling off and starting to maybe fall. And then the next chart shows Tesla leading other automakers like BMW, Daimler, VW, etc. And for many reasons we've discussed, 2022 should be a big step up for Tesla on this chart. All right, the other note we've got here is from Deutsche Bank. This was from Friday, but after Tesla's earnings report, they had a chance to follow up with Tesla Investor Relations to, quote, gain more clarity on this shift in near-term strategy. So basically 4 areas here they followed up on: a cheaper Tesla, FSD, one-time items, and the Tesla bot. First, they write, quote, Tesla confirmed to us it is currently not working on a lower price vehicle and seemed to attribute it in large part to its conviction that the prices of Model 3 and Y can come down considerably further in order to serve cheaper segments of the market, end quote. Okay, great. No surprise to us there. I've been making that point since before earnings. On FSD, they write, quote, the company's goal is to complete development and deploy autonomous driving software this year, which will achieve safer than human driving level without the need for the driver to supervise the vehicle. We note that Tesla sees autonomy as either supervised or unsupervised, not leveled. A driver either needs to engage, hands on the wheel, or be able to totally disengage. Tesla's goal is for FSD to reach what could be considered level 4 autonomy by regulators by the end of this year. As such, Tesla will start to seek approval from the regulators for a release by the end of 2022. Prior to achieving this, much larger deployment of beta versions should be expected. We would expect the number of beta testers to grow considerably further than the 60,000 currently in operation with each iteration of the beta, end quote. So I think that does add some helpful clarification, especially the part about Tesla not thinking in levels. I think I've argued that before, that Elon doesn't think in that way. So I think having that stated directly can help us understand what Elon is saying when he is speaking about FSD. Next up, on operating costs, they did mention the $700 million headwind in the quarter that we had talked about. Nothing surprising here, but they did confirm that $360 million of that was from expedite and warranty/recall costs, and then $340 million being from that CEO payroll tax. Last up was the Tesla bot. They say, quote, lastly, in our call with Tesla, the company reiterated its commitment to the Tesla bot, aka Optimus. Currently, Tesla has a team of engineers working on the development of the program, which it views as potentially its most disruptive product to date. Management does view it as a quote-unquote side project and indicated that the program is full speed ahead, given the view that Optimus could serve to solve the labor shortage issue in facilities across the industry. Tesla ultimately hopes to complete a prototype by the end of this year and could begin to market it to other companies in the years to follow once it demonstrates its ability to handle menial tasks in the workplace efficiently, starting in Tesla facilities, end quote. So I don't know, a little bit confusing there, or conflicting, calling it a side project, but also saying full speed ahead and big commitment. I guess I would take it more as a statement that obviously Tesla is still very focused on what's going on with cars and energy. So nothing too surprising there. I think probably the biggest thing, just the confirmation that yes, Tesla does believe in and is targeting unsupervised driving by the end of the year. All right, last few things for today. Tesla has expanded its non-Tesla supercharging program. Previously, that was just at a few superchargers in the Netherlands. Now Tesla's expanded it to include some superchargers in both France and Norway. Tesla does reiterate that their goal is to eventually expand this to every supercharger worldwide. Next, we've got an update from TeslaScope. They are reporting that Model 3 performance vehicles produced in China are shipping with heated wipers. Now, usually this doesn't actually mean heated wipers themselves, but rather a heated base at the windshield so that the wipers don't get frozen in place. If you live in the Midwest, often during snowstorms, you'll see people pulling their wipers up off of the windshield to prevent that. So this would take that job and not look quite as weird. Next up, CNBC had the founder and chairman of Interactive Brokers on today, and he brought up Tesla in the course of the conversation, noting that, quote, the very largest holding of Interactive Brokers customers is Tesla, and they have such huge gains in the stock, they do not want to sell it, end quote. He was implying for tax reasons there, but also added that, quote, they are committed to Tesla on the very, very long term, end quote. So I'm glad to hear that that segment of Tesla investors is not getting shaken out. Lastly today, since it is now Tuesday, February 1st in China, it is the beginning of the Chinese New Year, so happy Chinese New Year. Tesla, like they did last year, sharing out a nice little Tesla-related graphic. And then they also put together about a 1-minute video or so, which we've tended to see them do a little bit more of in China, a little bit more marketing heavy there. But I do think this is mostly for social media. Anyway, you can check that out at Tesla CN on Twitter if you want to watch the full video. That's where we'll leave it for today. I'm going to rest the voice up, hopefully better tomorrow. but thank you for bearing through it. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for that February 1st episode of Tesla Daily. Thank you.